Today, I'm going to run you through my investing mistakes and what I wish I would have done when I first started investing. For those of you that are early in your investing journey, this video is going to specifically be tailored to you. The reason I'm making this video is because when I was 20 years old and just opened up my first investment account, I wish I would have stumbled upon a video like this. I want you to hear this from someone who's already made the mistakes so you don't have to pay for them the same way I did. This video is going to be authentic and transparent, and hopefully helping you become aware of common pitfalls of investing mistakes so you don't have to walk off the same cliff that I did. Comment down below if you made investing mistakes when you first started investing and what those mistakes were so we could all grow and learn together. These mistakes I'm going to go through are in no particular order. I'm just going to talk about the mistakes that first come to my head. So let's get started. One of the biggest mistakes I made in my 20s was treating retirement accounts like something that I could deal with later. Even though I knew they were important, I didn't quite feel the urgency of using them properly. This is mostly because I was young and fresh out of college, and I thought saving for retirement felt stupid at the time. I felt like at the time, going and spending my hard earned money on other things and just putting it in my regular savings account. I went from making a couple $100s a paycheck in college to over $2,000 per paycheck, so it was a big jump for me at the time. I did contribute to my 401k and ended up maxing it out for the first 4 years of my career and getting the employer match, which I made a video about that a few weeks ago, and that was awesome. However, the mistake I'm talking about here is just not understanding to the full extent all of the potential retirement accounts that I could have been saving for. While the 401k was awesome and I'm super glad I maxed that out, I did not invest in a Roth IRA or an HSA, two of the biggest tax advantage accounts out there, until my third year of my career. I will have to say that I'm very fortunate and thankful about the 401k maxing out, but I certainly left a whole lot of tax advantage money on the table. What I didn't fully appreciate back then is that investing in a Roth IRA was a use it or lose it, and every year that I didn't contribute was a year of tax-free growth that I never got back. And when you zoom out over 30 and 40 years, that lost compounding for my first 3 years of my career seems massive to me. I'm going to put this into perspective for you guys with my favorite example to use, and that's the wonderful and reliable compound interest calculator. So looking back, let's assume I had maxed out my Roth IRA every year after college, and just keeping the numbers at $7,500 a year for simplicity's sake for this example, getting a 10% return on the market would yield me about $2,700,000. Now we're going to use the same formula, but decrease the years invested in the Roth IRA by 3 years. Let's say instead of starting at 22 years old, I start at 25 years old, which is what happened in my situation. I would then get only $2 million. The $2,700,000 and the $2 million are what I would be receiving at age 60 when I could live off my Roth IRA. That's nearly a $700,000 difference because I decided to let 3 years slip and not utilize my tax advantage accounts. It kind of hurts to see this now, but honestly, I'm not going to dwell on it too much because you just can't change the past. Time is your biggest advantage when you are young. So do not take this for granted and let this example be a wake-up call. If I could go back, I'd make maxing out my Roth IRA and HSA one of the first non-negotiables in my financial life, even if it meant having to make small sacrifices in the short term. Another mistake I made in my 20s was thinking that I could outsmart the market by picking individual stock winners, and I realized that this is a very common investing mistake. Data shows that being simple and investing in broad market ETFs works incredibly well over long periods of time. I spent too much mental energy researching individual stocks and trying to go down the Reddit rabbit holes and the Wall Street Bets page to find the next stock winner. For every one person that you hear wins big off of a day trade or doing options trading or just picking that GameStop or AMC stock, there's 99 other people that lost money, and you'll probably never hear their stories because people only want to share their highlight reels. I'll be 100% transparent and tell you my experience with this and why I stopped trying to pick individual stock winners. I think everyone remembers back to 2020 when GameStop and AMC went to the moon and everyone was supposed to get rich overnight. That's what I thought too. And that's what I thought was going to happen to me, but instead I ended up losing close to $1,000. I saw a guy post on Reddit and he made a couple $100,000 trading GameStop and AMC, and I also wanted a piece of that pie too. So on that crazy market trading day in 2020 or crazy market trading week, I bought GameStop and AMC thinking I was a genius and I could time the market. Little did I know these stocks ended up plummeting, and I panic sold thinking that I was going to lose everything, and I locked in a loss of $1,000 within just 3 days of buying and selling all these stocks, back and forth, back and forth. It was a good wake up call for me because it made me realize that day trading and speculating was not for me. I could have put that $1,000 into the S&P 500, not even thought about it, and had $2,000 today off that same investment. The irony is that complexity and trying to outsmart the market felt productive at the time, but simplicity would have been way more profitable, especially when my account balances were smaller and the biggest edge I had on my side was time. The third mistake I made in my 20s was trying to time the market and getting scared to invest when the market was at all time highs and trying to dump all of my money into the market when I thought it was at its lowest point. What ended up happening was that I waited for pullbacks to invest my money, but those pullbacks never came. So I sat on cash because things felt expensive at the time. And I delayed investing money that should have been in the market simply because I was afraid of buying at the wrong time. This behavior was more common during my first 2 years of my career when I just started to figure out about investing. What I learned the hard way is that the cost of waiting is often far greater than the cost of investing early, and that missing just a handful of strong market days can drastically reduce your long term investment returns. I saw this chart that paints a picture of what it looks like to miss the best days in the market, and I'm going to put it on the screen here for y'all to see. Let's say you begin investing and you put a lump sum of $10,000 into the S&P 500 and let it sit for 30 years and you didn't touch it. You would have over $224,000. Now let's say you just sat on that initial $10,000 and tried timing the market, but just so happened to miss the best 10 days of the market over the last 30 years. You would only have $102,000. That's over half your potential gains wiped out because you tried timing the market. And it gets even worse. Say you missed the best 20 days, and now you only have $60,000. Say you missed the best 30 days, and now you only have $38,000. And this is over a 30-year window, too. Just let this be a prime example of how costly it can be to try to time the market rather than just stay invested. However, this example was used with a lump sum of $10,000 for investing, and I believe if you dollar cost averaged into the market, it would help you limit the potential of missing out on some of the best days, which is why I always dollar cost average into the market no matter what's happening, just so I can have my money invested when the best days do come. If I had consistently invested as soon as I had the money, instead of hesitating and second guessing myself, I would be much further ahead today, not because I picked better investments, but because I gave them more time to compound. This is a mistake that I won't be making again in the future. Now hopping into mistake number 4. In my early 20s, I underestimated how important having a good emergency fund was for my foundation of investing. Because without an emergency fund, life events that pop up are going to prevent you from being able to consistently invest. What I should have done before I started investing was grow my emergency fund to at least 3 months of living expenses so that I wouldn't have to delay investing to pay a big bill or buy that emergency plane ticket. There were times when I invested aggressively in my first couple of years when I got into my career without a fully built emergency fund. And while nothing catastrophic happened, it added unnecessary stress and forced me to think short term when the markets got volatile and made me second guess my investments. In hindsight, if I had already established a good emergency fund, I could have been dumping all that extra money into the market and continued dollar cost averaging my way, even when the market was at its downturns. If you are going to dollar cost average into the market, like my strategy has been in the past, it's best just to stay consistent and not have to go back and forth while you're working to build up an emergency fund. Now, I understand that there are big emergencies in life that could deplete your emergency fund, and that's totally fine. But in my certain circumstance, I had no reason why I couldn't have just first built up that emergency fund in my first few months of working. Instead, I went and spent that money. I tried to invest aggressively before I knew what I was doing and made all these prior mistakes I talked about earlier in this video. Having a good emergency fund isn't about being conservative. It's about giving your investments room to breathe so you're never forced to sell your investments at the wrong time. And once I finally built a solid cash buffer, my investing decisions became calmer, more rational, and more long-term focused. Now, mistake number 5 for me would be chasing individual stocks rather than ETFs. Individual stocks can be great, and I have nothing against people that have had success with picking individual stocks. But that was not the case for me, and that's why I'm going to consider it one of my investing mistakes. In hindsight, yes, I would have loved to invest in Nvidia, and I would have loved to invest in Palantir. I would have loved to buy a house in 2008. I would have loved to buy Bitcoin in 2008. But that's all hindsight, and I just didn't put enough time into researching individual stocks that I chose to invest on early in my investing journey. I would have been better off investing in ETFs like VU or growth ETFs like SCHG, which I'm invested in now, but I just left some money on the table by neglecting the easy and boring way of investing, and that's investing through ETFs. ETFs provide more diversification than individual stocks. While they don't necessarily have the potential upside, they will protect you on the potential downside. What finally clicked for me was realizing that successful investing is about having a process that you can stick with through the bull and bearish markets. And once I shifted my focus to that and dollar cost averaging, it helped me stop chasing returns and building a system that actually worked. In your 20s, it's easy to assume your income, expenses, and priorities will stay relatively stable, but I'm telling you they won't. If I could go back 5 years, here's what I would do. I would build up a good emergency fund and pay off any high interest debt. I would prioritize learning about what investing is and what I want to invest in. Then I'd create an investment plan based on my time horizon and define when I would want to live off the money that I'm investing in and what accounts to use because of that. Then I'd prioritize investing in tax advantage accounts and getting any free money through an employer match. And then I'd automate my investments regardless of what's happening in the world so that I could stay invested and dollar cost average into the market and enjoy the ride. The point of this video isn't to say I failed my 20s because of these mistakes. Understanding these mistakes is key to not repeating these in the future for me. And I'm thankful that I even started investing in my 20s. Investing will probably never feel perfect, but if you take one thing from this video, just one thing, it would be to just start investing. Out of all the mistakes I discussed in this video, not starting earlier is the one that's going to hurt the most. But not all hope is lost because I still have a lot of time to invest, and hopefully by making this video, it can inspire people to begin their investing journey and working towards building their financial freedom. So if you found this video helpful, consider subscribing and let me know in the comments again what investing mistakes you might have made and what you're trying to avoid because we're all figuring this out together. I'll see you guys in the next one.